All right, let's talk overseas equities. For that, we're joined by Nathan Bell from Peters McGregor from our Sydney CBD studio. Nathan, great to have you on board. We were talking to George Boris, and he was singing the praises of offshore equity investing at the moment, particularly as people talk about stretch valuations here in Australia. But I suppose you could make the argument for many equity markets around the world. But let's talk China, if we can. We spoke about it last week. Continues to be a bit of a focus for you guys. But how do you go about it? How do you get the information, disseminate the opportunities, and particularly, I suppose, park to one side the white noise around China?
Yeah, I think the first thing is you want to have the currency hedged if you can. I think the debt problems in China, that sort of those macro issues, are very real, and when the Chinese economy starts to slow eventually, there's a major risk of a devaluation. So I think that's number one. Number two is we're looking for companies where there's a lot of insider ownership. We've all heard the stories about CEOs and other important people going missing in China. So we very much want management's incentives alongside ours. And thirdly, we're actually finding more value in the technology stocks, unlike the US. So the most recent company we bought was a company called Tencent, which is potentially the largest company in the world that most Australians have never heard of. It has a mobile messenger service which is free and has about 950 million monthly users on there, with half of them spending at least 2 hours per day on there. At the moment, it's actually making most of its money from online gaming, and it's growing revenue at nearly 50% per year. So even though you're paying nearly 40 times earnings, that's about the same multiple you're paying for a Fisher & Paykel Healthcare or a ResMed or Cochlear, and yet it's growing twice as fast.
And can I ask, when you're buying shares in these companies, is it generally through H shares, Hong Kong listed shares, or are they sort of A direct listed shares into China? Yeah,
so a couple of the stocks we own we've bought through ADRs, which are listed in America. So just bear in mind you're still going to get the full currency effect through those shares. And Tencent we own through the Hong Kong exchange. So these are companies that you can definitely buy as a retail investor as well as a professional.
And Nathan, do you look at ETFs as a way of sort of tracking, some of those Chinese equity markets?
I haven't specifically, because we're really trying to pick our spots. The worry I have about ETFs, particularly in the US, is that you've basically, from the bottom of 2009, you've had a 17% annualised return for about 8 years now. So now I actually think there's a real concern that you're just buying a very diversified portfolio of overvalued stocks. And same in China, I think the technology companies are very much like what you think about Google and Amazon back in the GFC, is that those tailwinds are going to blow behind those companies for a long time to come, regardless of what the macroeconomic backdrop looks like.
And do you tend to stick at that bigger end of the market, bit safer?
Yeah, I mean, that's just where we've focused our energy so far. I think there's a lot more companies to explore in China, but it's a big country with a lot of businesses, and that we're just sort of sticking with what we know so far and gradually branching out.
Now, we often talk to you, Nathan, about the banks, not only, in the US, but in Europe and the UK. And actually, the UK Treasury has just sold the last of its shares in Lloyds Bank. Tell us a bit more about this and whether you like investing in this bank.
Yeah, so Lloyds Bank is basically the Commonwealth Bank of the UK. It's by far has the highest return on equity. It's the low-cost operator, and it's all cleaned up since the GFC, so it doesn't have any more of those lingering problems. One of the last reasons that was keeping investors away from the stock was that the UK Treasury still had an investment from it. That was from the bailout, essentially, through the GFC. But the Treasury's now sold the last of its shares, and I wouldn't say Lloyd's stock has responded in kind necessarily. It's the highest price it's been for quite a while, but I think that's just more to do with the fact that dividends are still going to increase, and the bank's done a really great job of holding its net interest margins pretty steady, unlike a lot of other banks around the world in low interest rate environments. But unfortunately, I think most of the value has been realised.
So you'd be a seller. I think one of your former colleagues, Steve Johnson from Forager, has had an interest in Lloyds, either still does or in the past.
He has, but one area where I agree with Steve also is that I think there's better value in Europe. Steve's buying sort of smaller banks than what we are. We tend to buy bigger blue chips businesses. So we're in ING Group, which is based in the Netherlands, but it's also a fairly big bank here in Australia. But it started in 1992, I think it was, in Germany from a standing start, and now has a franchise with over 110 billion worth of deposits.
Goodness.
And so it's going around the world with this very attractive online deposit rates, has very happy customers, and then over time it sells more and more sort of mortgage and lending products. So you can buy banks in Europe at around 1 times book value with return on equities going from 10% and above which is something that you could have done in the US sort of 12 to 18 months ago. So I think Europe is the place to be looking for bank shares.
Just finally, moving across to the US, the TV, or the cable TV operator, I should say, Charter Communications, who I believe you are an investor in, they've reportedly rejected a takeover offer there from Verizon. Tell us a bit more, and I guess your thoughts around this and what it means more broadly for the sector.
Yeah, so the US cable TV industry is not that well understood in Australia because it works quite differently, but essentially these are quite monopolistic businesses. And just by pure luck, it turned out that when the internet was invented, the best way to deliver fast broadband to the home was through the cable TV pipes. And so a lot of people have been worried about skinny bundles and people watching Netflix and online and people scrapping their cable TV bundle. But what they don't realise is actually these are the same guys that offer the internet service, and the incremental margin for adding someone to the internet broadband business is about 99%, whereas with the TV business you've got to pay sort of half your revenue away to content providers. And so what we've seen recently is Verizon, a huge telecommunications company in the US, struggling for growth and looked to buy Charter Communications for about a 25% premium to the current price. Charter's turned it down, but we're obviously very happy there's interest in our company because we own an indirect shareholding in Charter. But it tells us that over time, basically the cable TV, internet and telecommunications industries are going to merge.
All right, Nathan, always great talking to you. Appreciate it. Thank you.
Thanks, guys.